In today's video, I'm going to show you how to profit from the volatility in the markets, specifically the futures index markets. We'll take a look at all four of the major index markets. This includes the S&P, the Dow, the Nasdaq, and the Russell, and I'll show you what the volatility looked like and how to take advantage of it. I'll share a step-by-step process that you can follow. It's simple, it's easy to do, you can do it yourself, along with one setup, the fade setup, which allows you to follow a very simple set of rules to take advantage of this volatility. Now, the first step is understanding what the volatility looks like in the morning. This is once the market's open, you use whatever clues you can gather to make a sense of what the volatility landscape looks like. Now, for us, we use our Futures Volatility Box models, and we send out a morning volatility note that looks like this. This is today's volatility note for May 1st, and this is the beginning of a brand new month, so we did see a little bit more volatility than we're used to typically seeing on Mondays. Now, this morning volatility note is your cheat sheet. It gives you a volatility landscape of the 10 major futures markets. You can see all 10 of the markets here. We have the four major indices, we have the 30-year bond, we have crude, natural gas, copper, gold, and silver. This gives us a nice overview of what the volatility looks like and where we have opportunities we can take advantage of, along with which markets we want to be ignoring altogether, where, say, we don't really have an edge anymore, which was copper and silver today. Now, the way to make sense of all of these models is by understanding their order. We have 5 different models, and it goes in order from scalper all the way to doomsday conservative. And if we were to visualize this, this is what it looks like. This is a line graph, and really as we go from left to right, that means we're seeing more volatility in that particular market. So now if we zoom in on the index markets, which is what the topic of today's video is, there we can see the S&P, Dow, Nasdaq, and Russell. The S&P, Dow, and Nasdaq were all on their scalper models. Meanwhile, the Russell was on its aggressive model. So if we plot this on our line graph here, it becomes a little easier to see which markets have less volatility, where scalp trades are perfectly good, they're allowed right now, compared to the Russell, which had more volatility, broken outside of the scalper. We couldn't really be looking at scalp trades there. Let me show you how this looks like on the charts. Here's all 4 of the major futures markets. And remember, we're looking at the volatility 30 minutes after the market opens. That gives us basically 1 full hour's worth of volatility where this yellow line is. And we use that to make a good sense of what the volatility is currently looking at. Now, if we see the S&P here, we can see the S&P had volatility where we had a rally in the morning. We hit our sign entry lines on our volatility box models. This is typically where we're looking for entries. So in this case, a short side entry. And we can see here the sellers did in fact defend those levels. So this gives us confidence. We know the sellers are coming in where we would expect. It's telling us that, hey, the scalper model's all good inside of the S&P. Same thing inside of the Dow. Price rallies, and then we see sellers come in, defend that level. Tells us the scalper is all good inside of the Dow here as well. The Nasdaq here, way less volatility compared to the S&P and the Dow. We don't even get close to the sign entry lines up here. And that tells us, again, the scalper's all good. We contrast that with the Russell. Much different story here. The Russell not only breaks through the sign entry line, but breaks through our clouds, exceeds it, and we can see price action goes outside. Once we go outside, that's telling us that, hey, the sellers aren't coming in here where we would have expected. Instead, buyers have much more control here. We need to be a little bit more cautious. The scalper's not doing a good job of containing price action. Instead, we switch over to the next model that we have, the next most aggressive model, and that's the aggressive volatility box. Once we load that in, you can see that's doing a much better job of containing volatility, very similar to the S&P. We hit the sign entry line here, and then we see sellers come in and defend this level. So that tells you now that the aggressive model is the one to use if we're looking to fade price action. Now, with all of this understood, we knew our morning landscape. The S&P, the Dow, and the Nasdaq, all on their scalper model, so we're looking at scalp trades here. We need price action to hit either side sign entry lines, and then we see our overbought, oversold signal. Now, we had setups really across the board here today, and I'm going to share the different setups so you can train your eyes. You'll see how the setup varies in something like the Russell, where we were on the aggressive, compared to something like, say, the S&P, where we were on our scalper. So let's get started here. We'll start with the S&P first. Let me maximize this chart and we can go through. So we're looking for, again, a breach of our sign entry line, which we can see happens in that 8 to 9 a.m. Pacific hour. Price action sells off and we come and we tag our sign entry line. At this point, this is step 1 of our fade setup, and that's telling us that, hey, we've now hit a level we care about. Now we're really looking to get long here if we can see our buy arrow, that's this green arrow right here, which tells us that, hey, we're now officially in oversold territory and we're looking for buyers to come in and bring price action back up and for price to reverse. If that were to happen, our entry's at the sign entry line, our stop is outside of the volatility box clouds. That was a risk of about 4 points in this S&P trade, and we're looking for that same 4 points in the opposite direction for our first target, and our second target is this gray line that you see on the other side, which is T2. Now, if I keep scrolling forward here slowly, we can see price action comes in, and we have this rally right here inside of the S&P 500, and that rally hits that beyond that 4 mark, the 4-point mark. We go all the way up to about 5.75 points in the S&P. So we've hit T1 already before we even saw our green arrow in the S&P. That's telling us that, hey, that's okay. At least we know that we are seeing buyers come in and this level is being respected. Now we saw green arrows take place near that 8:30 mark. This was in a retest. Retests are not valid for me per our trade plan. I know many of you like to take retests, and if you did take the retest today, then you were rewarded pretty handsomely inside of the S&P. The retest gave you not only your first target, but also the second target and led to a real nice rally. Now that rally took us in that 9 to 10 a.m., so this is the lunchtime hour. It took us into the lunchtime hours opposite ends volatility box, and this is now a short side setup we're looking for. Same idea, breach the sign entry lines, see the edge signal confirmation, and I was looking for an entry at the sign entry line, and we never got that here. Price action just went and hit T1 before giving us that opportunity, and one more time, real nice dump all the way back down into our long side entry, and the long side entry also hit T1 without giving us an entry. So the S&P here was a classic tale of having our setup hit our first targets, even our second target, some brilliant moves, but if we were waiting for the retest, which is what our trade plan suggests, didn't give us an entry. And I know many of you might have been a little bit more aggressive. For me, I found retests typically tend to keep me out of more trouble than actually help here. Now we switch over to the Dow futures and we repeat the same process here. Inside of the Dow, if I zoom out here, and I can go through this one a little bit quicker now that you know what the setup looks like, we had a few different breaches. We had the same short side breach in that 9 to 10 a.m. hour, which led to a real nice sell-off, and then that led to a long side entry here inside of the Dow, where here we did have our rules get met. We had price action breach our sign entry line, we had the buy side arrow, we had plenty of opportunities to enter at the sign line or better, and we really just chopped around. We didn't hit the stop into the close, and we didn't hit our target either. So this is a trade basically taken off its scratch to slightly a little bit less if you got out towards the close in that very final bar. But outside of that, price action just chopped between that sign entry line. Now we move on to the Nasdaq futures, and I know a lot of you like the Nasdaq. Nasdaq, less volatility to start off the day, so if you were to be a bit more aggressive on one market, you could have argued it would have been the Nasdaq. Keep scrolling forward. First entry, or first breach rather, came in that 8 to 9 a.m. Pacific hour, where price action sold off into our sign entry line. We then had price stabilize, but it had already hit T1 here. We were looking for a move in the Nasdaq for about 13 points. And we went all the way up to 20 points before we actually got our buy side arrow here. One more time, retest did work. In today's case, not one that I like to take, but you were rewarded if you were a little bit more aggressive today. Now the Nasdaq here also triggered the short side setup. The short side setup also hit T1 in that lunchtime hour, a little bit funky price action there. We then saw buyers try to bring price action up. Didn't really happen. Had a sell-off in that 11 to 12 p.m. Pacific hour. There, price action hits our sign entry line. We had the oversold confirmation, and this too hit T1 one more time without hitting the sign entry line after seeing the arrow. So today across the board, the theme again was if you took advantage of the retest and you were rewarded handsomely. If not, it was a little bit of a frustrating day, to be honest, because you were just sitting there waiting for the retest opportunity while seeing price action go in the direction that we were looking at. Now we switch over to the Russell, and the Russell is the market in which we actually did get an opportunity to enter, and we were rewarded for following our rules and being a little bit more patient. Now here we were on the aggressive volatility box models, and there's same idea. In the 8 to 9 a.m. Pacific hour, we had a sell-off. That sell-off took us into the sign entry line. So right here is step 1. We then saw our oversold confirmation signal. That was step 2. Here we had plenty of opportunities to enter at the sign line, so we actually did get our entry opportunity. Our stop on this particular trade was outside of the volatility box clouds, about 4 points worth of risk. And we hit that 4 points of risk and even made a max move of about 10 points, but we fell just a little bit short of that second target, which would have been a nice greedy type of T2 level. So inside of the Russell here, we were rewarded finally for our patience in that 8 to 9 a.m. Pacific hour compared to the other markets where the retest never really came. Now the rest of the day inside of the Russell, we just chopped around sideways. We had price action reverse when the other indices also triggered the opportunities here in that 11 to 12 p.m. Pacific hour. But you can see in the Russell, we don't get anywhere close to the level we were looking at. So one more time to summarize, today particularly, we had 3 of our 4 index markets on the scalper volatility box models and 1 of our index markets on the aggressive model. In the scalper model, we had to be very aggressive with retests in order to actually participate in the moves, but there we saw the moves take place in brilliant form, hitting really extended levels both on the long and short side setups, but we never got the actual entry that we were looking for following our trade plan rules. Those of you being a little bit more aggressive, not waiting for the cyan line, but instead using the section between the cyan line and the gray area as your entry, you're rewarded today, and if you're an options trader, you probably had some nice trades today as well. The Russell was the market where, despite being the more volatile market, gave us a real nice setup there where we followed our rules, all of our trade plan rules were met, and the Russell gave us a nice winner. We're hopefully looking for more volatility, for this volatility to continue as the week progresses and to take advantage of this volatility whichever way you'd like. For all of our stock traders, the stock volatility box also gave us some nice opportunities today. One that I can show you real quick is GE. GE was one of the stocks which hit our overlap tab. And there you can see we had price action hit our volatility box clouds. Same idea, we had the rally in the morning. We then saw price action stabilize. We saw our overbought confirmation signals here. And we then saw a nice reversal inside of GE from that level. So same setup, different asset class for those of you that like to trade stocks instead of futures, or for those of you that have access to both, you can find plenty of other opportunities inside of stocks when the markets are being a little bit fussy like the ESYM and Nasdaq were today in terms of the retest opportunities. All right, I hope today's sort of thorough overview of the trades was helpful for all of our Volatility Box members. Take care, everyone. Good luck trading. I'm looking for this volatility to continue this week, and it's a nice change from some of the quietness that we've been seeing for the past few weeks. Take care, everyone, and I'll see you in the next update.